What's up, guys? Dom Trimboli here from Refinancer, and today, the 6th of September, we have got ourselves the RBA's decision on the current cash rate. And as everyone expected, it's gone up by another 50 basis points. So that's bringing the cash rate up to a total of 2.35%. And it's pretty massive news considering on the 6th of April, you can see here it was zero point 0.1. So it's gone up by 2.25%. And that is absolutely massive. It's going to affect every homeowner, even prospective homeowners, and it absolutely will change the marketplace. We're already seeing some pretty massive changes as well in housing, inflation, just everything from, buying a car to your general groceries. This stuff's affecting everyone, and it's important to kind of get a bit of a feel today as to what this means. And yeah, this is my live reaction going through it. So let's hover through the statement. We're not going to get too into it. So we can see here the board decided to increase by 50 basis points to 2.35%. And, they're committed to returning inflation to the 2-3% range over time, which absolutely makes sense. Once again, going over the Ukraine situation and, even China, kind of passing the buck here. We're not going to increase interest rates to 2024. Oh, wait, we're doing it now. But yeah, it's not our fault. It's, let's blame Russia and China. So pretty standard there. Inflation's the highest since 1990s. Yeah, we're all feeling it. And yeah, we've had our peak. And yeah, everyone's talking about the impact of rising interest rates, medium-term inflation, and yeah, the bank's central forecasts for CPI inflation to be around 7.75% over 2022. Cool. So the Australian economy is continuing to grow solidly, and national income is being boosted by a record level of terms of trade. Yes, I suppose maybe. Cool. And wage growth has picked up from the low rates of recent years. I think a lot of people will question that potentially. And they're talking about uncertainty and household spending. Further increase in interest rates today will help bring inflation back to target and create a more sustainable balance of demand and supply in the economy. Price stability is a prerequisite for a strong economy and sustained period of full employment. So they've backed their decision. They've given some reasoning. Whether we agree with it or we don't, that's what's happened. Now let's kind of plug this in and see what this kind of means to the Australian, well, the average Aussie. So let's say we're talking a $500,000 loan. I won't do the best rate. I'll do the probably average rate you would have had before today, which is about 4% on a variable. So as you can see, your weekly repayments would have been $550. As of today, or most likely in the next month, those repayments are going to go up from $550 all the way to $584. So that's another $34 a week. Geez, that's quite a bit. $130 or something per month. So absolutely material. That's, almost half a tank of petrol per week right there gone. In fact, probably a full tank of petrol over a fortnight. So that's what's happened. And it kind of comes under the radar a little bit. I think everyone was thinking maybe things were kind of calming down. Everyone's kind of hearing that property stopped. The data will support that. Maybe not so much in Adelaide and Perth, maybe Queensland, but I think it has taken a bit of a fall in the eastern suburbs. All right, so what do we do now? And I might sound like a broken record, but this could be your last chance to now do this strategy. The big thing that no one is talking about with these rate increases is borrowing capacity, right? And to be honest, this is a big factor in why property is actually going down. Like I'll give you a scenario. You might have a homeowner in, let's say Brisbane that wanted to buy a $700,000 house. That homeowner was pre-approved for $700,000, and it's been that way for a few months. Now he finally finds a property, he or she finds a property and gives updated payslips to the pre-approval. Now, since the last assessment, rates have gone up twice. So that $700,000, that now becomes $580,000. So that homeowner or prospective homeowners now lost, 10% of their borrowing or whatever it is, 10, 15%. So they back out of deals, and we're seeing a lot of deals being backed out of now. Just had a client who was looking at a property, missed out by a few $100,000, and then the buyer of that property pulled out. So now that client's back in. So it's kind of interesting. And I think that's fueling why property is actually going down. And that's a big reason of why I think there's actually some opportunity in the market as well. And the reason why this ties into what you should do in terms of a refinance, right? And I'll give you a visual example here, just using a plain Excel spreadsheet, right? So, let's use a loan of $450,000 as something you might have right now. Now, your borrowing capacity is always in the background, right? It doesn't really affect you until you're looking to do a transaction. Let's look at your borrowing capacity, today, for example. Your borrowing capacity today would be worked out on an interest rate of, 4%, right? So your borrowing capacity may actually be something like 465,000, right? Now, the banks are going to pass the 50 basis points on. They've done it every single time. You can absolutely count on it. So we can kind of look at borrowing capacity in 1 month, right? Because it'll probably take between 5 days and a month for them to actually increase. So let's say your interest rate goes to 4.5%. Your borrowing capacity may actually go below what your loan is, right? Oop, definitely wouldn't go up by that much. So you might lose something like $30,000 in borrowing just because of this change. Now, why is that relevant? So it's not relevant if you're planning on doing nothing. So if you're planning on doing nothing, just wearing the higher interest rate and kind of paying bank loyalty tax for having something higher, that's fine. This doesn't affect you. However, if you want to be proactive, this may affect you, because if you want to refinance, they will qualify you on your current situation. And your current situation today may be this, but tomorrow it might be that. And that means you cannot service the loan you have. So what I am absolutely encouraging my clients to do, and I cannot underline how much I'm encouraging them to do this, is to take out a cash out. You don't need to stress about these interest rate increases if you're prepared. So for example, if you move today, we could do something like refinance you to a today rate of 3.49%. But of course, that is going to go up to 3.99%. You're going to get $4,000 cash back as well, as we talk about. And what we can do is we can increase the loan amount to 465,000, right? And that is going to give you $15,000 excess. And you're going to put this $15,000 in a redraw account. So you're not actually going to pay interest on this. So yes, your home loan has gone up, but this $15,000 is kind of like your emergency fund, and it's not going to cost you anything. And obviously in a month when the changes take place, you'll still be able to borrow the 465 because we acted now. If we act in a month's time before the banks change, then this will be your capacity. So, let's kind of make this nice and clear. If we can get it done now, you can absolutely handle this. So again, why should you be doing this? Why should you be doing a cash out refinance? It goes against the most basic kind of terminology of having a home loan. And okay, so it goes against that. You have a home loan, you want to pay it down. That is the old way of looking at things. The new concept is all about equity. Okay. So you got to ask yourself, if you don't do this and you have a home loan of 450 and you're struggling to make your repayments, what is going to happen? There's two things that are going to happen. You're either going to sell your home, not when you want to sell it, not when you can make money off it. You're going to sell it reactively. And doing anything reactively is how you don't make money, because reactive decisions are effectively doing what everyone else is doing at the worst time. So you don't want to do that. The other thing you're going to do is miss repayments or go on hardship. And we'd rather you sell your home than you do this stuff, because what this does is it affects your credit score, which means you cut off your options. And you'll also tell the bank, hey, I've missed a few repayments. I'm actually stuck here because of that. No one else is going to refinance me. And guess what the banks think when they know that happens? They're going to increase your interest rate, and not through RBA increases. They may just increase your interest rate out of nowhere to reflect the risk of having someone who's missing their repayments on their books. So this is absolutely not what we want to happen. Cannot encourage you to avoid this type of stuff more. So that's why if you can refinance today, you'll get this extra excess. Of course, you don't have to. It doesn't have to be 15. Could be 5,000, 10,000, 15,000, whatever. You're also going to get a $4,000 cashback, which is pretty enticing. It's it's for a loan amount of 250 plus, 250,000 plus, which is crazy. So if you've got a loan amount of 250,000, the bank's just going to give you $4,000 straight away. So that's pretty much my take on what's happened and what you should do. Honestly, I cannot recommend this strategy enough. It doesn't make sense if you're someone that's got a 465,000, if you've got a loan of $450,000 and your home value is something like $1.2 million, you've got $750,000 of equity in this home, yet you're stressing out about making your repayments. Just increase the loan to 465 and don't stress. Do yourself a favor, and the next 24 months, you will not have to worry about what's happening in the market. And ultimately, once we ride out these increases, and eventually the market will change. And the big reason why we think that's going to happen sooner than later is because of the 4-year fixed rates that have come out. We recently did a video on CBA doing a 4.99% 4-year fixed rate, and all the majors followed. So that's telling us that the banks aren't seeing interest rates getting too high over the next 4 years. More than likely in 2 or 3 years, maybe even sooner, rates will drop. And as soon as that happens, we can then lock in something at more favorable terms, whether it be 2.5%. So the name of the game right now is treading water, but don't go underwater and suffocate in the meantime, is probably the best way to put it. Now, if you want to get something like this started, you just need to click on the link below. Myself or one of our brokers here will go through this strategy in more detail. It's an absolute no-brainer in my opinion. If you're someone that's even a little bit worried about your current home loan position, again, why worry and turn gray and stress about your home loan when you don't have to? This is how people get sick, stress. So there's going to be more interest rate increases most likely over the next few months. Put yourself in the best position and just don't worry about this stuff. All the best, guys. Until the next time, we'll catch you. Make sure you like, comment, subscribe. Let us know if there's any videos you'd like me to do in the future. Happy to do them. And if you want to apply for a refinance or a new home, just click the link in the description. Take care. Bye.